when I buy companies, as I told you earlier, I buy it 1 plus 1 equals 4. 1 plus 1 equals 3 when you get, because every time you buy a company, you should get a bump in revenue through cross-selling. And then 1 plus 1 equals 4 because you have the SG&A economies of scale.
Basically, first you find one platform company, right? Then you start building the rest.
And when you combine it all, you get a better multiple. AI gives you the chance to be more quicker and better at your job. But I'm still in the people business.
Yeah.
You know, people still need to talk to people. Because you're trying to make sure that you're lawful and you're morally and ethically correct.
What do you think destroys the value after year 2?
The real problem with anything is integration.
Why do most integration fail? Welcome to Founders. I am Sardor Umrdinov, founder of Home Alliance Platform. Today I'm joined by Allan Hartley, a serial entrepreneur with over 40 years of experience in the staffing industry and M&A. Throughout his career, Allan has held senior leadership roles at major international staffing companies and later became the CEO of publicly traded businesses. Over the years, he has built, scaled, acquired, integrated, and exited companies worth hundreds of millions of dollars. He has completed and advised on hundreds of transactions across multiple economic cycles. Today, we are going to deep in roll-ups, platform consolidation, integration realities, valuation multiples, capital structure, and what it really takes to scale through M&A in 2026. Allan, welcome to the podcast. Let me start with a tough question. Allan, if you would start in 2026, you would still do the traditional roll-up or you would build a platform, you will do virtual roll-up?
All my roll-ups have been with a platform company first. Right. So I've always had a platform company and I would buy other companies off of that platform. So I've always had a platform and then underneath it I would do. So what I would usually do, my structure is pretty easy. I would have the platform and underneath it I would have all what I call wholly owned subsidiaries. And then they would have their own, and I did a little bit different than most. I like what I call the DNA of the companies. And what does that mean? I keep the name, I keep the brand, I keep the way they're doing business. And then we have synergies on the SG&A side and of course economy. And then hopefully we get, we do cross-selling on the revenue side. But in reality, they would have their own P&Ls and they would consolidate up at what I call the platform level. And the platform level is either a holdco, a holding company, or a pubco, or a publicly traded company. But that's really the way that I ran all my companies.
Got it. Do you think is classical P roll-up is outdated or not?
No. In fact, a lot of investors like roll-up strategies because you get, you're buying the companies at a certain multiple, and when you combine it all, you get a better multiple. So you get that arbitrage, right, between the smaller multiple of what you're getting.
What, 1 plus 1 is 3?
Well, when I buy companies, as I told you earlier, I buy it 1 plus 1 equals 4. And I go by 1 plus 1 equals 3 when you get, because every time you buy a company, you should get a bump in revenue through cross-selling and different kind of strategies. And I have a horizontal vertical strategy to do that, which I'll go over to later. And then 1 plus 1 equals 4 because you have the SG&A economies of scale. Because I don't need 2 controllers. I don't need 2 insurance companies. I don't, you combine that to economies of scale.
So because 1 plus 1 equals 3 on the horizontal integration, then it becomes 4.
That's correct. There you go. Yeah. I'm gonna steal that. Yeah.
Now tell me, what was your smallest roll-up?
Well, they all start small, right? Yeah. But in reality, the one I'm doing right now is probably my smallest. I'm rolling up a $10 million about $10 million worth of businesses. And I have an $8 million really platform where I'm bringing in about another $2 million of 4 small little companies. But these companies, I have really good growth plans for that. And I'm actually merging that into a publicly traded company, which is about $8 million to a TSX company actually in Canada. And that's probably my smallest. What I'm doing right now is probably my smallest. However, once I hit the TSX market and we're planning to go to NASDAQ and dual list on NASDAQ and the Berlin market and the Frankfurt marketplace, as well as the Dubai marketplace, I think it may be my most profitable one.
Yeah.
When it comes right down to it. Yeah.
That's cool. What was the biggest one?
The one I probably just finished up, there was a $440 million company in New Jersey that we took into NASDAQ, and then we just bought a $700 million company in Europe. And that's probably the biggest one. So that's be $1.2 billion total revenue with about a $20-30 million EBITDA.
Are you okay like sharing just not the name of the company, probably just deal structure?
I'm sorry?
Can you share the...
It's exactly the same structure. I mean, you have the pubco, right? And it's publicly traded. So it's a pubco is the main platform in essence. And underneath it, you have these wholly owned subsidiaries. The subsidiaries happen to be big. One's $440 million, the other's $700 million. And then we'll have other ones beyond them. There's like $200-300 million more worth of companies that we're going to do. And there's, so at the end of the day, hopefully this year we can be 1.5 billion.
Yeah. Wow.
Yeah.
1.5.
Yeah.
And basically, first you find one platform company, right? Then you start basically building the rest.
Correct. That's absolutely the best. To me, I find that the best. And not that too, but when you're with investors, it's hard to bring in a bunch of small companies. You still need a platform, right? You still need somebody to share the... there already has most of the cost already there, right?
Correct,
and then when you like we have marketing. If you think about a company, put it this way, you have expenses, right? And what are your expenses? Really, it's HR, it's pay people are your biggest cost, marketing costs and all that. And then you allocate those costs to the subsidiaries underneath it, really. So, and then they will also have it, but then that's part of the economies of scale, right? So, I don't need, two marketing companies. I need one, right?
Probably like my team, I have 200 people in my company now. Probably they could handle minimum 5 times more.
That's correct. That's correct.
We have holdco and we have subsidiary companies below.
Yeah.
And because we've been growing organically, that overhead, it stays on us. But we could easily actually like take in other companies and I don't have to add more overhead.
No. And the other thing too that I had one company that I started with actually, most companies, when you do allocation of costs, and there's 2 ways to expense it. One, you can just do a corporate allocation to the subsidiaries, with 2% of your revenue or 3% of your revenue, and then the platform company itself, or the holdco or the pubco, would give those services, the marketing service, the HR services and all that. Or you could just do quick, whatever the real allocation number is. So if I'm only using $200 of business stuff, then I only get billed, my company, my subsidiary only gets billed $200,
Right. Yeah, I think we have the similar structure. When it comes to just holdco, we pay a percentage of the revenue for the management company. And when it comes to the shared economy, like call center, marketing, recruiting, and we pay piece. Like for each appointment is booked, they pay $100 or whatever, like dollar for that. And their job is to optimize that P&L, the pub itself, but the management company just charges like MSO, management system organizations, separately.
Yeah. No. What I did is I came up with a concept called shared services, right? So one of the companies I was CEO at, I started looking at my SG&A on the holdco or the pubco level. And I said, I already have marketing services. I already do HR services. I do accounting services. I do all these services, even legal services, right? I said, so I remember I gathered all my salespeople. I said, look, I want you to go to small to medium-sized companies and sell these services, because I'm a staffing company, right? So if I need more people, I'll just, I can staff it, right? I mean, that's what I do as a, real. So anyway, so what my goal was to take my SG&A and to turn them into a profit center. All right. And I remember you telling me you were doing that too. So that's why I said we're always like-minded. So it's pretty, when you said it too, I said, God almighty, it's like it's reading my mind. But anyways, that is the greatest, and my board of directors loved it, because now I'm getting rid of my SG&A. In fact, I'm making it into a profit center. And I have my CFO as an example for accounting. He would share in the profit. I said, look, you can do this, and I'll give you a little piece of the, bottom line on your profit center, And I thought that, I came up with a whole thing on that too. When you told me you did it, I said, "Wow, that's probably you're about. I think you're the only person that ever thought of it besides me." So congratulations on that.
It kind of came business evolution wise, right? Like
you have
I looked
to.
at the Amazon AWS also they did it. First it was a cost center, then it became a profit center.
That's exactly right. That's exactly right. No,
Actually,
and you're
I think they make
correct.
more money on the AWS now.
Well, if you think about it, I look at it this way. If you think of all the businesses, whether it's small or medium sized, the big companies are, have their own, they're going to do their thing anyways. But if you're a small company or a medium sized company, you're going to pay, it's unbelievable what you pay for accounting services, marketing services. I don't have to pay that premium because it's not my main business. My main business is staffing. Right? That's what I do, right? But the other businesses like accounting and all these other services that I already do anyways for my own company, that's just gravy. You know what I mean?
No, that's why we came up as a platform, and we want to share basically the management as G&E with the rest of the other companies. So it's more on the shared economy.
Right.
They don't have to buy on the market price. We can just give them on the cost and everyone will benefit out of it.
That's correct. That's right. It's just, and it makes sense because my accounting department, as an example, they're adverse into it. I mean, I have CPAs. I mean, I have really good accounting department. And why not take advantage of it? And we know these small to medium-sized clients need these services, and if you can centralize that and just say, look, here's my menu, you can either do it a la carte or take the whole menu, Yeah.
Same thing.
No, that's why we're sitting here together right now.
What do you think is the best? Like 10 companies at 5 million or one company at 50 million?
I'll tell you, it's easier to do one company at 50 million. That I'll tell you. And the reason being is because you're doing the same due diligence, right? It's just, it's your cost way goes down when you just do one company versus 5 or 10 companies, because and I'm doing the same due diligence for a $5 million company as I am for a $50 million company. So that's the pros. Right. The cons, however, is that if you have buying that $150 million company, they already have the way they're doing business, and you can't. It's harder to change that versus 5, 10 small companies, right?
Correct.
So the pro is financially it's easier and financially better to do one company per se. That's the pros, and the con is that you're sort of stuck with that. The quorum, you might say quorum to do that, where again, at the 5 to 10 companies, you can, you have more latitude, more diversity, things like that, which I think count for a lot. The trick is maybe to do them both, right? So maybe instead of doing 150 million, maybe you get a 20 million, 25 million, and then bring in maybe 4 or 5 of these companies. You still need a platform. Right. So you still need a platform.
Otherwise, you have to build all of that.
Exactly. You have to build the infrastructure, right? Or you have to take one of those small companies and really build out that infrastructure. But you do need an infrastructure, which is all that SG&A, right?
Correct.
Yeah. And more importantly, also let's talk about revenue generation, because that's the main thing, right? Revenue generation to me is horizontally and vertically. And what I mean by that is horizontally figuring out whoever you buy, getting into more markets.
How can you share the same offer to the same customer many products?
Yeah, well, what I do, and then the vertical is the first thing I do when I buy a company, I look at a company I'm going to buy is, okay, I got this company. How do I expand it? How can I get into more markets? And then I said, okay, here's what they're specialized in. However, I have other services I can sell to their clients. So I call mushrooming the account, right? Because I look at every company every client that we have and figuring out what else can I sell to that client. You already did the hard work. You already got the client, all right? So how can I take that client and get even more business from that client? And also when I also look at a client, I always figure out is I really want that company to be a partner with me. I want to say, look, you're trying to get more revenues. You're trying to get a better EBITDA or a bottom line. We're no different than you. We'll help you do that, right? How can we help you do that? Now I'm in the staffing business, and and people costs are the biggest cost for most corporations. Well, how can we help you with that, right? You're going out to do an M&A deal. You're going to go out to do whatever you're going to do. We may be able to give you services that can help you provide at a lower cost and better a better solution than what you can do otherwise, right? So I try to become a partner with every client I can because it just makes it's just a better relationship between us.
So the value first you're getting is you are getting access right away to bigger market, right? Like company A's market and company B market, company C market. Now you have access to all of them.
That's correct.
Number two, now you can cross-sell the company A product to the company and B and C and further, and the company B product to the rest. So you're already cross-selling the product to the same customers.
Exactly right. You're a perfect example. I'm in the staffing units, right? So if I buy an IT company and I have all their clients are doing IT, well, I can provide accounting services because I have an accounting staffing division, right? I can provide HR services because I have an HR group that can handle that. I can even find executives. I have an executive search company, so there's different things that we can do. I like doing the executive search where we're buying an executive search company in my next company that I'm doing. And it's almost top-down selling because who do they place? They place C-suite. Right? All the C-suite. And so all the decision makers, all the market makers, right? And so now we can go in there and say, look, we already placed you and we were doing business with you. Is there anything you need? We also do, we have a light industrial division. We have an admin division. Do you need any admin people? We can do all that,
Interesting. So this way, when you are doing a roll-up and merge platform, private equity companies, they don't have to really do the hard work because the hard work actually bringing the really customer, right? In the beginning.
That's correct. That's absolutely correct.
When you merge it, you start getting economy of scale now.
That's exactly right.
Yeah. What do you think destroys the value after year two?
The real problem with anything is integration, right? And when it's easy to buy a company, do due diligence, and let me back up. When you buy a company, you look at valuation, you look at deal structure, due diligence, and then definitive agreements and all that. And then really the hard part is the integration. Right. And I remember we talked about
it's a cultural integration.
Yeah. Well, there's a lot of integration, right? You have finance, you have the SG&A integration, right? Because you want to do economies of scale of that, right? But it's culture and all that. But hopefully you do your due diligence right.
Yeah.
Okay. And I know when I do due diligence, I have a whole checklist of things that I look for in the due diligence that you'll be able to catch the red flags before year two even begins. But the real deal for any, as far as I'm concerned, is really the people. Yeah. Really, right? Because we're people, we're only as good as the people that we buy, in essence, right? And if the people start to go south, it doesn't work out right.
What was the biggest lesson on integrations like?
Is to make sure that when I do due diligence, that I already have year two mapped out. So before I even buy a company, I know my expectation, I know how we're going to grow that company and what my expectation is. I already have the budget for set up, and it's not me that's setting up that budget. It's the people that I'm buying and myself. We're collaborating on that. So they bought in and I bought in, and then I also put a financial incentive to that. So it's their incentive to go ahead and do that, and they've already bought into it because they helped me set up for year two. Yeah. They already know what year two is, because I look at a company and said, okay, how are we going to grow the business? And it's not me that's telling them. We're working in collaboration with that, right? Yeah. So they already bought into it, and that's the key.
Basically, you're not really buying 100% of the company here. You're actually bringing the leadership together, right? It has a higher chance of staying instead of like once you bought the company and the owner or the leader leaves, then everything falls apart.
That's correct. I usually do not buy a company unless higher management stays or the owner stays.
Yeah.
Because I don't know their company, you know what I mean? And I'll tell you a quick story. I was with a major staffing firm, and I got a call from them and say, look, we in our Orlando market, we bought back our biggest franchise, right? It's about a $40 million franchise. And, but they let go of the franchise owner. And of course, the franchise went from 40 million to 20 million. So I went in, the first thing I did is I bought that franchise owner back, right? He knows his business. I don't know his business, you know what I mean? So, I mean, I know the business, but I don't know the Orlando marketplace like he does, or the intricacies. So and that was, all of a sudden a light bulb went off in my head. Scott, I will never do that. Yeah. So I will never buy a business unless I have ownership, who stays with it and also incentivize that owner. Why would he want to come in with me, right? So when an owner wants to retire, I have no problem with that, but I got to make sure second generation management, is good with this. Also, when a manager, when somebody retires, what are they doing for the business? If they're bringing in the bulk of the business and they retire, it's that to me is a red flag.
Yeah.
I
Yeah.
mean, it's going to be tough. What's going to happen? What's going to happen a year from now when the businesses who he's bringing in, the dawn on him, God, he's no longer there anymore, and all of a sudden it opens up, and I don't want to take that chance, you know.
Have you saw any companies doing that kind of mistake? Like
Everybody does. I just
everybody?
told you that one company who let that manager go, right? I
Yeah.
mean, the owner go, right? And then went from 40 million to 20 million in not even 8 months,
Wow.
on a run rate, and it was
Wow.
just incredible, and I said, God almighty, why would, and the guy they let go was a great guy. I said,
Yeah.
"Yeah, are you kidding me?" So we ended up bringing him back into
And
the
he
business
came
right
and
back up.
fixed it back, right?
Oh yeah. Oh yeah.
Yeah.
Because he knows what the,
That was
he
that's
knew the
good.
customers, knew the clients. And I went back to the CEO. I said, why would you, what made you do this? He goes, well, I thought we can do it. We had the systems. I said, well, duh, it didn't work. But it
So
dawned on me too. Never,
so the leadership, the culture,
big
finances,
time. Yeah,
systems,
yeah,
correct?
yeah, yeah. And
Yeah.
you have to have the same mindset too. When you take a company public, you got people want to go public, right? Or if they want to go to a strategic, you have to have that, or go private equity, which is a whole nother world. I've even done an ESOP deal, right?
Yeah.
An employee stock option program. You have to have that mindset, and you have to have the buy-in.
Hmm.
That's the key. Because if they don't have the buy-in and they're just doing it for the money and all that, it's just not worth it. It really isn't. You need the buy-in. You need to have the same fit. You
Yeah.
know, when I buy a company, I try to, you want to bond with the people and the manager. I have every time I buy a company, when we first buy a company, I'll have what's called a town hall meeting where everybody comes in and I explain exactly what we're doing.
Yeah.
Here's what it is, and you get their buy-in, and because you want them, you know what I
Yeah.
mean? You're only as good as the people that you
Correct.
buy, you know what I'm
Correct.
saying? Otherwise,
Correct.
don't even do it. And I'm not doing widgets, I'm not selling, I'm actually, I'm not a manufacturing company, where I'm in the
You're
people
working with the
business.
people,
Yeah,
correct? Yeah.
exactly.
Yeah.
Right.
Yeah.
Yeah.
Yeah. Yeah. And when you're structuring those ESOP deals or structures, like what percentage of the pie you put it on side for the ESOP?
On the ESOP deals, I just learned it really because I just put a $200 million company on an ESOP deal, and it's my first. I heard of it obviously,
Yeah.
play stock, but I never did it until then, and it's kind of interesting because it's tax. There's a lot of tax free
Yeah.
incentives to that, and then there's also a debt piece I think goes with it too.
Mhm.
But the owner does really really well, and not just that, but what's key to this whole thing. Even when I take companies public, it's really the stock or the stock option programs.
Mhm.
Because, I remember when my first company I ever got stock in, um, and I had no idea. I was nobody know I mean, I was a kid, right? And I got stock, and I said, "Oh, good," I had no idea what it means. But everybody in the company got stock,
Yeah.
even the administrators and all that, and it was really an eye opener because everybody now we used to put the stock price on the board, our whiteboard back then, there was a whiteboard. But this employee stock option program is the same thing because now you're an owner of the company,
Correct.
right? So you want the
Correct.
company to do well
Yeah.
because it only enhances your value
Yeah.
for you
Yeah.
personally.
Yeah.
That's why everybody likes the stock option programs, employee stock option programs,
Yeah.
because again, it gives the employees, whether they're an admin person or all the way to a CFO, C-suite,
Correct.
it gives them incentive
Right.
to help their company grow.
Yeah, yeah, because if the company is doing well, their stock option goes up, right? Like
Exactly correct.
they do well.
Yeah,
Yeah.
exactly right.
Eventually, probably that's how you kind of exited with a big good check, right?
That's
Like,
exactly right. Yeah, and if you're an employee stock option fund, when you retire or you leave, you get that,
yeah,
the value of that
it's
company, right?
it's
You
probably
get that too.
sometimes it might be better than a pension plan, right?
Oh, it should be because if everybody goes right, yeah.
Correct.
Interesting enough, when I buy businesses for 401ks. Sometimes my stock or the employee stock option program. Now that I've just got into it, it has a better return than a 401k.
Right, right,
You know.
right. What do you think the biggest illusion founders have about the roll-ups?
The couple of things that I feel the illusion would be that first of all, it's easy to roll up. It's not because you have to have as we talked about earlier, the right mindset. Right, you have to have the same mindset. You might say of the roll up, and make sure the owner has the same mindset, and that's an illusion because you figured okay, everybody wants to do this roll up. Also, you want to get that economies of scale. It's not that when I keep saying integration. Well, besides we talked about owners and all that, but financial integration, you need somebody, and especially on the CFO level, who can actually put this thing together.
Right.
All right. It's harder than you think because remember now, when you buy a company as a roll up, right, you're buying a company and they're used to doing, I've had so many companies tell me, well, I bill a little bit different than everybody else. And they really don't. It's just, little minor changes, but they think that
They're
that
unique.
it's unique and it is unique maybe to them and all that. So, but they want to make sure that uniqueness
It
stays with
stays.
them, right? That's why I said we keep the DNA of the company because we keep that uniqueness. So, so you have to make sure that is
But when
happening,
it comes
right?
to accounting, finance is black and white,
Yeah,
right? So
exactly. But it's not as you think it is because again, everybody thinks it's, I have to bill my company this way or I have to do my payroll this way. In reality, it's the same, but it's just uniqueness in that
correct.
particular space. I get it. So, but you have to be mindful of that.
Yeah.
And people don't think of that when you're doing roll-ups. They think, oh, we'll just bring everybody in the same, payroll systems and we'll do that. It's not. You have to still make those changes, right? So anyway, so there's that part of it. And then also that when you roll it up, and remember we keep going 1 and 1 equals 4 in my world, right?
Yeah.
You have to make sure that actually happens.
Yeah.
Right. And then also the other thing, when you're an investor or you're in the higher level of this and you're actually putting this together, that everybody thinks that when you do a roll up, that you're going to make more money or it's going to really happen. Well, it doesn't really happen. It doesn't unless you actually put the work in to get it done. Because theoretically, investors like it because you're buying the companies at a certain acquisition price or a certain multiple. It's
Multiple,
4
correct.
multiple, 5
Yeah.
multiple, and then when you add them all together, you
Correct.
should get a 6, 7, 8 multiple. If you're
Yeah.
public, it's even a little bit more. But let's say just on a private sale. But you have to have to show the market or you have to show why you're getting that big multiple. A lot of it is I know in the public markets they like to see size.
Yeah.
So the $440 million company we did is size, right?
Mhm.
The 700 million we bought in is size, right?
Yeah.
So that's the key to this. Even the company I'm doing now, we're starting off small, right? At 10 million, we're adding an 8 million because they already are 8 million. So let's say we're on 20 million, give or take, but we know we need to get to size in order to, if we want to dual list on NASDAQ or we want to go to other places with it. And more importantly, to get the return for the investors or the
Mhm.
shareholders,
Mhm.
right? I always, when I was a public company, you always think of shareholder value.
Yeah.
How can I get that shares up? How can I
Correct.
get the shareholder value? So
Yeah. Do you think it's 100% ownership is overrated?
no, 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 because what's good about 100% ownership is that when you do decide to exit,
Yeah.
right, you have 100% of the money coming in, right?
Okay.
So, no, I think 100% ownership is great. If depending on if you're one of the companies that you're looking to sell, right? You want to do a merger, you want to sell
Yeah.
your company.
Yeah.
Obviously, the 100% ownership, you make the money, right?
Which way is better? Do you think like holding 100% and try to exit all the way yourself, or merge and you do the swap of your equity, then you exit together?
That's a good question, and my answer to that is the bigger you are, the more money you'll make. So you have to look at, does 1 and 1 equals 3 on the merger side, right?
Yeah.
So right now, if I'm a company that does 20 million and I do a $2 million EBITDA, 10% as an example, and let's say I sell it for 5 times, so it's $10 million,
Mhm.
give or take, right? And then I'm going by my industry. And then if you combine with another $20 million company, so now it's 40 million. But instead of doing a $5 million EBITDA multiple, it may be a 6 EBITDA because you're
Correct.
bigger now,
Yeah.
right? So you
Yeah.
got to weigh how much, and all that.
Efficiency.
And then the other thing you have to weigh on too, if you merge in with somebody, who runs the company?
Mhm.
Okay, is it you or is it the other $20 million company, right? So that all has to work out.
Yeah.
And not only that too, but when you merge, you also have to make sure again to get proper valuation, to get that bigger valuation, you have to have economies of scale on the SG&A. You still have to have you figure out how to take that 1 and 1 equals 3 on the revenue
Yeah.
side and 1 and 1 equals 4 on the SG&A side. That still has to come together.
Yeah. I think one of the greatest virtual mergers was PayPal
Oh
Mafia,
yeah.
when
Yeah,
Elon
yeah, yeah.
Musk and the Peter Thiel and all of them kind of merged together to one company, and they sold it to eBay, right?
Oh,
Like,
yeah. Oh, yeah. No, no, yeah. Believe me, I'm only dealing in my world, which is smaller than their world, but you're right, yeah.
yeah, because if they would not exit it together like that, they won't be able to build the next billions of dollar
Well, it's funny
company.
you say
Yeah.
that. I have remember remember I got involved with the ESOP guys, right?
Yeah.
And so I was talking to my main guy that I was talking to in ESOP, and we started talking about, because he knows that I merge companies together to go public. So we said, Alan, instead of going public, why don't you take a bunch of companies and go ESOP, instead of going public, do ESOP. Same concept, right?
Yeah.
You're going, employee stock option versus stock. And I thought about it, I said, yeah, but again, and I keep thinking about it, how do I get the most value? Because even ESOP has to create value,
Mhm.
right? You still need a multiple. You still need you still need the same concept as you do a
Mhm.
publicly traded company, and you still need some kind of a platform, or you need some kind of, you need something to put it all together. Otherwise, you're gonna have all these different companies. And he was on vacation. He just got back, so I'm going to get more detail on that because he literally just got back. But the concept is the same. So I just want to get more clarity on that part of it with an ESOP. But to my thinking is you still need to get that. You still need that platform. You still need
Yeah.
a head of the head of the snake in essence, right?
Yeah. Yeah.
Yeah.
Yesterday, I think I shared with you, the BlackRock announced about their acquisition of the Champions Group,
Oh yeah, you did.
home
Yeah, yeah,
service,
yeah. I
home
looked at it real
service.
quickly. I didn't.
Yeah,
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 for I
yeah, yeah.
think $2.6 billion.
Oh yeah, yeah. It's my type of group.
Even the
Do
BlackRock,
they
like,
need any staffing? I'll help them. No, go ahead. They
maybe.
probably do. Yeah, but anyways,
What about scale or versus EBITDA quality?
EBITDA quality is still the most important by
EBITDA
far. You
quality.
you need profit. I mean, I can,
Yeah.
it's funny when I buy companies and I have an earnout, I want to make sure that they're not giving the business away just to get a better revenue number,
Mhm.
right? I need profit, right? And everybody looks at profit.
Yeah.
So the answer to your question is quality of profit is
Yeah.
by far the biggest.
Probably like recurring revenue also will add a
Oh,
lot.
recurring revenues,
Is the
again, the
multiplier goes
SaaS and
up,
all the
correct?
SaaS
SaaS
environments and all
multiple,
that
yeah,
recurring revenue, that's true.
yeah,
However, it all has to filter down into a better profit,
yeah, yeah.
right?
That,
Because I can
that's
have recurring revenue, I'm making $1, or I can have recurring revenue, I'm making $100.
yeah,
Which company is better, right?
yeah, yeah. That's why, like, one of the main reasons we have implement membership programs
That's correct. Yeah, that's
for
right. Because
recurring
you want that.
revenue.
Well, recurring revenue is key.
Yeah,
Right? Remember, I told you concentration of client. Then you
correct.
also have recurring revenues. I
Yeah,
mean, there's a bunch of factors to
yeah,
go into when
yeah,
you actually come up with a valuation of
yeah.
a multiple, right?
Yeah, but otherwise, in emergency services, like, how you can really like predict the
That's
revenues,
correct.
correct?
That's
You have to
correct.
always spend money on marketing, but this way, when you sign them up on subscription, now the client comes back whenever
That's
they
right.
need
Well,
emergency.
and I'll go in my industry, the permanent placement industry, because they're mostly one-offs.
Yeah, yeah,
Somebody needs a controller, you fill the controller, and
yeah.
that's it, and then you got to go find another controller job. Contracting, however, the consulting is they're going back to work the next day,
Yeah,
so you have recurring revenue, right?
yeah,
Versus that, so a contract business has more. For the most part, has more valuation, you might say, better value, you might say, than
mhm,
a one-off type of business.
got it. The business you talked about, the control, what percentage of the revenue you guys normally charge? 30%?
Anywhere between 25 to 30%.
25,
Yeah,
30%, right?
yeah.
Got it,
That's
got it.
the average,
Yeah.
And if you retain, there's 2 types of permanent placement, right? You have retained,
Mhm.
which is more of a 33%. It's more of a high level
Yeah.
retained business where you get a third, a third, a third up front, a third in the middle after you do certain things,
Uh-huh.
and a third when you place. Where the contingency is usually between 25, 30%. Could go down to 20% depending on the level,
Mhm.
right? Remember, it's really a triangle. So
Yeah.
you have your top, which is really the executive search, high level C-suite type model. And then you have the mid-size, the
Yep.
middle, right,
Middle.
which is more of that white collar mid-size. Then you
Mhm.
have the blue collar, which is the bottom part of the triangle. The lower you go in the triangle, the less
Percentage
margin you
drops.
get and the
Yeah.
less I can charge. So for permanent placement position on the lower end of the triangle, go anywhere between 15 to 20%.
Yeah.
The middle triangle will be 20 to 25%,
Yeah.
30%, and then you get that 33% up on the top.
30%. Good. Interesting. Does the coordinated exit creates arbitrage?
Oh, yes. Yes,
Yeah.
yeah. The arbitrage, again, the biggest arbitrage on a roll-up, again, is you're buying the companies and that's why investors like it. You're buying at a lower multiple than when you have the whole. And so therefore, because I'm buying and the investor is giving me money to buy at 4 or 5 times. If I go public, it can go up to 12 times. You know what
Yeah.
I mean? And they like that arbitrage, 10 times, and go the arbitrage. If I do a strategic, it's just going to help their multiple go better. right?
Yeah.
So if I'm at a 6 multiple, I'm buying something at a 4 times in a sense. I'm already at a 6 times already. So, you're already at that 6 times. You already made the arbitrage on that. You know what I mean?
Do public companies have to always acquire companies to like
Yeah, you
to
always have what I call feed the beast.
yeah,
All right.
yeah,
And
yeah,
it
yeah,
really
yeah,
is. It
yeah,
really,
yeah,
that's what I
yeah,
call
yeah.
it. Yes, the answer to your question is yes. You always have to keep, there's only two ways you're going to grow a company: organically or mergers and
Mergers,
acquisitions,
acquisitions,
right?
like, but when you are
And,
too
but
big, it's harder to grow, right?
yeah,
Like
that's why you have to do these mergers and acquisitions,
mergers,
because you're only going
acquisition.
to grow so much on organically.
Correct.
When you're smaller, you have a big organic play. You
Yeah,
can actually make a lot of money. When you're really big, though, it's
yeah,
tough to go 10%, 20%,
yeah,
30% growth. That's why you buy companies. And
yeah.
and in the
And they're not really
you know,
paying cash; they're paying with their stocks,
oh
right?
yeah, we use stock as currency. That's why
Stock
people like the
currency.
stock play. Yeah,
Correct.
yeah, yeah,
Yeah.
yeah.
So basically, they're worth on like what some companies might worth 20-24%. Correct?
That's
Like,
correct. Yeah,
yeah,
I tell everybody never, because when I buy a company, there's always a stock in there, right? And I tell the owners, don't discount the stock. You're getting it for $1 a share
yeah,
today,
yeah,
but if we do what we say we're going to do, it's going to go to $3 a share.
yeah,
You're going to triple your money.
yeah,
So instead of a 4 times that I'm buying you or 5 times that I'm buying you, if the
yeah,
stock matures in 2-3 years, because I
yeah,
usually have 3-year deals, you know, instead of you can go up to 6 times or 7 times
yeah.
when it all shakes out after 3 years.
Yeah.
Mm.
In our home services, like on PropTech, there is a company called Service Titan, and they exited to IPO on 33 times of the top line revenue,
Mm.
not the
That's very
bottom,
good. Yeah, that's
top
very
line.
good.
Like
Yeah,
I
yeah,
think
yeah.
they do about 250 million or something like that, or
Mhm.
maybe a little more now, 275. And they exited on like almost $9.9 billion, like $10 billion, right? I think the stock is now kind of dropped now. It's probably like 6.6 or
Yeah, I'll
something
tell you
like
right
that.
now, it's funny. I have stock, right?
Yeah.
And you can't look at the stock market.
Yeah.
My family looks actually, stock, and they said, Dad, I remember my father when he was alive, he would say, my stock goes down a dime. He goes, Alan, the stock went down a dime. I said, Dad, don't do this. Don't do this. I said, please, just let it. I don't even look at it. Just let it ride. And really, because
Yeah.
the stock
But
market
for
is,
that,
there's no, I can't even control it for that matter. I can
correct.
control what I can control, but the
Yeah.
stock market's got other external factors.
Yeah, yeah,
You
yeah.
know,
The White House can announce something.
and then it goes down. We had
Because
COVID. Boom. You know what I mean?
boom, correct.
It's just
Yeah, yeah.
insane. You can't do that. It's a longer play for the most
Correct,
part, and you just
correct.
can't,
But even
you
for
know.
them, in order to continue grow, they have to acquire a company,
Oh
right?
yeah, no question
That's
about it.
it.
Mergers and acquisitions is the biggest way.
The biggest one. They
Yeah,
have to
yeah,
just
yeah.
continue
That big
acquire
company I
big
was talking
company.
about, the
Correct.
1.3, the 1.2 billion.
Yeah.
I talked to the management of that group, and all the time they're saying, Alan, what else can we buy? What else can we buy?
Yeah.
Because they know they need to do that, and not just them, but all these public companies.
And when they are trading on whatever the multiplier, when they can acquire like 10, 20, $50 million company, they add it on the top of whatever they have.
That's
Now
correct.
they
That's
stay,
correct. And
right?
like we talked about, size
Yeah,
matters, right?
yeah,
So the
yeah.
bigger, the more companies,
And they
yeah,
can
yeah.
actually announce to their like on quarterly like
Yeah, because
meeting.
they have to do quarterly earnings, right? And it
Earnings,
has,
correct.
what I like about public companies is the transparency.
Yeah,
There's no, you can't, good, bad, or indifferent. This is what
yeah.
it is, right? And I always like that, the transparency in this, and then let the chips fall where they may, right?
D-
And you could do whatever you can do. You do the best you can to get your revenue up and your EBITDA going.
Yeah.
You have good management, good practices. You do as best you can, but at
Do,
the end of the day, you did what you can.
do you know one interesting things I always do is I go I have some list of companies in the public traded, and I pull out their like quarter and yearly reports. Like
Yeah,
it
yeah.
might be Uber, it might be DoorDash, it might be Service Titan, and I basically pull their report and actually look at the really detailed P&L, how that P&L SG&A looks like, and I try to kind of
Mirror it?
mirror it.
Yeah, yeah,
Yeah,
yeah,
yeah,
yeah,
yeah.
yeah, yeah, yeah.
I kind of mirror it to
Well,
my
I
company.
look
So
at
that,
my competitors and I look at just the staff. I'm in the staffing industry.
yeah,
So I look at those,
yeah,
staffing companies. Same thing. I have a stock watch list
correct.
as well. And I have stock in some of these companies anyways, but I always do the same thing. I always say,
Yeah,
what are they doing, that I'm
correct.
not doing,
Yeah.
So,
Because P&L kind of tells you the strategy,
Oh
right?
no,
What is
without a
like,
doubt. Oh yeah, not that, but also they have to, they put announcements out. You look at
correct.
the
Correct.
PR releases
Yeah.
and all that,
And just imagine like that kind of big company, they have probably like so many genius, like smart people sitting and
smarter than
working
us.
on that. And actually you can just copy the strategy,
That's
right?
right.
Like
That's
you
right.
just learn from them.
Yeah, that's right. That's right. Yeah.
Yeah, you
Yeah.
can
Yeah.
apply those things.
My old boss used to say, when you make a mistake, my old boss used to say, "You just paid tuition. Did you learn from it?" I always I told him when he said, I said, "I'm going to steal that." I use it all the time now, but it's true. So you make mistakes, and God forbid you do. Well, everybody makes mistakes.
Yeah,
Did you learn from it?
correct.
And that's your tuition,
Yeah,
right? And
yeah,
then
yeah.
you hopefully you grow.
But if you can actually watch, if you have mentors and if you watch others, and you might kind of skip that mistake, right? Like
Oh, yeah,
hopefully you
no, that's
can
the whole
learn them.
purpose of it,
Yeah,
right? You try to avoid what you can,
correct,
right? Yeah, yeah,
correct,
yeah, yeah.
correct. Yeah,
But no, I'll tell you right now, you always will make
you
some
will
kind
make,
of
of
mistake,
course,
but
of
that's
course.
we're human, right?
Yeah,
So
of
that's what
course.
it is.
Yeah, yeah,
Yeah,
yeah.
yeah.
I think we learn more on our own mistakes than
Oh,
others.
no, without a doubt, because it's you're actually in the middle of it,
We
right?
get
Yeah.
scars, right? Internal scars.
Yeah, yeah, because you're actually paying that price,
Yeah. Whatever doesn't kill you, whatever doesn't
That's
knock you
right.
off,
That's
it's
right.
actually a good lesson.
That's right.
I think we just discussed that. Why do institutional buyers pay premium?
Well, it's the same thing. They
Yeah.
pay a premium, and that's the goal, by the way, for a public company. You want institutional buyers, right?
Yeah.
That's the mecca.
Yeah.
But anyways, again, it's a bunch of factors. There's not one factor, but obviously the main factor is financial, right?
Correct.
Because they're bankers,
Yeah,
really.
yeah.
So they're looking at the EBITDA line,
Right.
the revenue line, what's the growth spurt, what
Yeah.
can happen, and the business itself. There's the mitigating factors, but the biggest factor is financial.
Yeah,
You need
yeah.
a good revenue line.
Yeah,
and you
because
need
I
a good
think
debt
that
line.
BlackRock paid premium for Champion Group because home service is really stable during the crisis.
That's correct.
Yeah.
That's correct.
Like it's essential. And what is happening now with the real estate? Commercial estate gone. Like
That's
all
right.
of them empty. They're sitting quietly. They actually, I think, like dropping them off one by one.
Well, I'm from Boston, and what they're doing with commercial real estate there, and probably everywhere, they're making it into housing now.
Correct.
Because they have the space,
Correct,
right?
correct.
Even malls,
Correct.
like
But people
they're
don't
going
want
to.
to. But people don't want to stay in the big cities anymore, right?
Oh
Like
no,
they already
want to
moved
move out.
They want to
Well,
move
it's
out.
becoming. I noticed also in some malls, they're
Yeah.
making it into housing.
Correct.
Because
Yeah.
nobody's going to the malls anymore because
Yeah.
everybody's shopping online,
Yeah,
right?
yeah.
So these big, like these anchor stores are gone.
Correct.
So they make them into housing now.
Yeah, yeah, yeah. No, I think like there was what happened to the real estate after the COVID, and what is happening with the crypto market, right? Like all the Bitcoin and everything has crashed, like gold crashed, right? What else are you going to invest the money, right?
Yeah. Well, I'm in the people business, so I invest in people. So there you go. So, and then it's kind of interesting the way. My business really, even though it changed technology big time, I wish I had LinkedIn when I was running a desk, but or the tools, the AI tools and all that. But I didn't have that when I started the business, and it just further helps you get more done, at a quicker pace, really.
Correct.
And that's, but I'm still in the people business.
Yeah.
People still need to talk to people per se.
Right.
You know what I mean?
Yeah.
So it's just what it does. Technology just really quickens I could do more work because I have more tools at my disposal. So instead of doing 5 or 6 people, I put 6 people out. I could put 10 people out because I could do it quicker now because of technology.
Yeah, probably probably your people are implementing. Are they implementing AI?
Oh yeah, you have to. In my business
optimize?
especially, it's easier to optimize the recruiting structure,
Correct.
right? And then also even the sales structure, right? Because
Yeah.
there's so much out there, so you have to delineate yourself. And one of the ways that it's still in my, I'm an old fashioned, and I have gray hair, so you know how old I am. But I'm old fashioned in the sense that you still need people to people contact, human contact.
Yeah.
In order to make placements, in essence. However, what AI does for us, it gives us the better candidate that we can present
Mhm.
at a faster clip.
Yeah.
Right. And that's what AI does to us. It really helps us crystallize that.
Yeah, yeah. Actually, we have internally built a tool, like it's again, right, on the holdco level, for the group of company in the platform, where it has the information about, it does a style assessment, disc assessment,
That's right.
the hierarchy of
They all do that.
Maslow,
Yeah. Oh,
all
yeah.
of
Well,
the
that's what AI
platforms.
does.
Correct. Yeah, it does. Yeah. And
We
it will
talked about
tell
it
you.
in the car. I have to do an analysis.
Yeah.
It takes me like 5 seconds to do analysis, where in the old days I'd have to, pay somebody, or I do it myself and take hours. Now
Correct.
it's, nothing,
Yeah.
and it's the evolution of technology, right? It just keeps getting better
Correct.
and better and better. And again, it just quickens the pace. It gives
Yeah.
you more chances to make the right,
Yeah.
to place the right person, at
Yeah.
least
Yeah.
in
Yeah.
my business,
Yeah. Like I had to do it now. Like I'm learning wipe coding. Like I already got up to the level 4 or something like
Oh,
that,
good
and
for
I
you.
have
Yeah,
developed
yeah,
like a lot of new platforms
yeah.
myself and learning it. And even though I think like by the time this video is gonna show up in few months, I think it's gonna be over wide range. Everybody's gonna be doing the wipe coding.
Uh,
And but I just installed the CloudBot
yeah.
also, and I'm gonna be training my own AI. And then I think in few months everybody's gonna have one or maybe many.
Everybody's gonna do it anyways. Well, in our business, sometimes you want to do white papers, right?
Yeah.
Well, everybody, you don't have to do it. It's real easy now. You just go to AI and tell
Mm.
them what you're looking for, and analysis, and you get the white paper done in minutes. So that changed that whole concept. But it's industry. I love it. Because you have to grow.
Yeah.
You know what I mean? And you have to use it. You learn it.
Correct.
And but I think it's great.
Yeah.
I really do.
3 red flags that kill deals.
Well, first of all, the main due diligence is financial, right?
Uh-huh.
So if the financial due diligence does not check out, that kills the deal right away. So if they say they're doing $1 million, in reality they're only doing $500,000, that kills that deal. That's gone,
Yeah.
right? Because
So you have to have a proper
so
quality of
you have
earnings,
to have
basically.
quality of earnings,
Yeah.
or audited statements,
Mhm.
or something like that. But that is the quickest way that that is the red flag.
Yeah.
The second one would be the people, right? You
Uh-huh.
got to make sure that your philosophy is compatible to their philosophy. That's what due diligence will show,
Mhm.
right? And then the third part for me, anyways, is the future. Right. We talk about the second year, right? Third
Mhm.
year.
Mhm.
Do they have based on what I'm seeing in due diligence, and I talk to the people, the people I'm buying, well, during due diligence, how do we grow your company? So that's got to be compatible to what I'm going to do,
Mhm.
right? So if they said, Alan, for me to grow, twice my size, I need this, and that, and it's infeasible for me to do that. And it's just, they're so different than what I can really do. That's another way. So those are really the three structures that I look at to make sure
How long
that my due diligence goes right.
how long you do the due diligence?
I usually say that on a public company, it's anywhere between, or it's around 60 days after
So say
LOI. After you sign
after
an
a while.
LOI, about 60 to 90 days,
Yeah.
depending on the size of the company. Sometimes you have to do audits and things like that. On a private company, 30 to 60, depending on the
Yeah.
size of the company. Obviously, if it's small, maybe 30 days to
So after
45
you
days.
sign the LOI, like do you what do you normally do right away?
Well, let me back up.
Yeah.
So when I first am interested into a company, I deal with brokers because they will show me companies. The thing that I ask for is I need at least 3 years P&L,
Mhm.
minimum two. I need an up to date balance sheet. I need an accounts receivable aging, and I look at the aging for concentration of client and payment history.
Mhm.
And I don't really care the name of the clients, even though I like to see the name of the clients. But again, that's the most important part. I need an org chart,
Mhm.
and I need, if they have a pro forma for like
Future. Yeah,
2026 or
yeah.
something. So those are the bare nuts but they're things that I need. And then once I have all that, then I request a meeting with the with the owner.
Mhm.
Right. And then I go through, I have a little checklist that I look at, what kind of an ATS system they have, different, are they self-funded? What kind of an accounting system they have? How many people do they, getting more involved in the, what is you have an internal employees, what do they do, that kind of thing. And then once I have all that information, then I go back and do what I consider an evaluation, or
Mhm.
how am I going to buy the deal structure.
Mhm.
Then I go and say, okay, if everybody agrees with the deal structure, then I put that into an LOI.
Mhm.
Then that kicks off the due diligence.
Mhm.
And then during the due diligence, like I said, you talk about next year and go through the due diligence. Then you get the definitive agreements, and then close.
Biggest post-closure surprises.
That's a good question. Well, we sort of take care of the surprises in the definitive agreement, because I have in my agreements that to make it easy, anything before close, their problem. Anything post-close, it's my problem, right? So if something comes up, they're getting sued or a tax issue, that's their issue, right? If I'm doing a stock deal, an asset deal doesn't matter. But if I'm doing a stock deal, which I do mostly, that's what I would do. So so that's my biggest surprise if something comes up, like a client, a big client leaves.
Mhm.
Right. And that's my problem because I should have saw that in the due diligence, right? If I do my due diligence right, I shouldn't have any surprises. But that could be a surprise. I'm one of a major biller leaves. And
Mhm.
I may not know that even through due diligence because he may be saying, "Yeah, I want to join you. I want to join you." Then he leaves, right? So then I'm screwed, right? So that's a big issue for me, right? So because I'm losing a
Mhm.
revenue stream, right?
Yeah,
Because my
yeah.
big biller's leaving, right? And so those are probably the biggest surprises, I guess, in my business.
Got it, got it. And you do most of the stock deals, you don't do asset because it's the mid-market, right? Like,
I'd rather do asset deals because you have less exposure. However,
but you
and
cannot do it. You're bigger companies. You
yeah, but
normally do
well,
us.
if I'm a publicly traded company, it's all stock deals, right? You want to do stock
Correct.
deals, right? Because what you're trying to also with a stock deal in my business is you don't want to. If I do a stock deal, I take over all the clients, I take over everything, right? And what I don't want to do if I do an asset deal, because sometimes if you have a change of control or something happens on an asset deal, I may have to go back to the client and have them re-sign an agreement, which I don't want to do.
Mhm.
Right. I don't want the client to say, "Oh God, they're changing." And I said, "Well, maybe we ought to look at their agreement again." And I don't want that to happen. Also, the employees, as a stock deal, they automatically come with you,
Yeah,
right? In a sense, an asset deal, I'd have to put out
yeah.
they have to do
You
new
have to
agreements,
hire
right?
them
Right.
again.
Right. A stock deal is easier. You have, but again, if you have the good reps and warranties in your definitive agreement, they're really not an issue. And again, I come back to my old adage: if it's before close, it's their problem. If it's after close, it's my problem, right? So God forbid they get sued because an employee was suing them for whatever reason, and it happened a year ago. That's their issue, not my issue. So I'm not responsible for that.
How much normally it costs to close a deal?
Depends you have to pay lawyers and you have to pay accountants. Those are the two biggest costs you have. And a public deal, there are a lot. When you do a public company, it can go anywhere from 500,000 to 1.5 million, literally.
Yeah.
Okay, to go public and to
Mhm,
do all
mhm.
that. When you buy a company, you have to. It can, depending on the size of the company, it can go 15,000 for a lawyer fees, give or take 10,000 for lawyer fees, depending how small it is, and then your accounting fees, right? So, but I have if it's a small deal, my CFO can handle that,
Yeah.
right? Because he's savvy enough to do that. If I need an accounting or if I need a fairness opinion,
Mhm.
right, then it's going to cost me money to do that. So that is really but the true cost for that is all that. Then of course you have just the time.
Mhm.
Right, because it's not just me as an owner or as a CEO doing it. I have other people involved in this, right?
Mhm.
Because I may have depending on what I'm buying, I may have my CEO need to talk to these guys, right? To
Mhm.
do help with the due diligence and all that. So it's just time cost as well as actual physical cost.
Yeah. Let's talk about integrations. Why do most integration fail?
Because it's a couple things. Remember I said that 1 and 1 equals 3 because of financial
Mhm.
because you have the economies of scale of SG&A, right?
Mhm.
So that is one reason we have to figure out a way. I usually say 5 to 10% on the bottom line, just on SG&A savings. That we have to figure out a way that does happen, and that you should know that during due diligence. By the
Mhm.
way, if you do, by the time you get integration, if you do your due diligence right, you won't have a problem in integration because you already figured out those issues already. And the other issue is besides the financial, making sure you have the economies of scale stuff, is to make sure that the systems integrate, right? So, we have software, ATS, applicant tracking systems, CRM, that the sales, all that. You got to make sure those systems are compatible to what you're doing as well.
Mhm.
So you got to, and that's during due diligence phase, by the way, but that'll also hurt integration, right? Because if you want everybody on the same platform, and it's not, there's that. And then the third is to make sure that even though you do due diligence, you got to make sure the people are compatible to the people that you're already working, that's already in your company.
All right.
right? So those are really the three things. So it's operations, financial, and people.
Can shared services replace heavy integrations?
Yes, and I'll tell you why, because I keep going back to that economies of scale, right? So I have shared services of the answer is yes, and I'll tell you why, because one is let's use human resource as an example. I don't need as much human resource services to the actual portfolio companies because
Correct.
I have it on the top level,
Yeah, yeah,
right?
yeah.
So that's one of it. Accounting for sure, right?
Mhm.
Now I do need each
You
company
did
that each
AP, AR,
subsidiary
ARAP,
yeah,
that's it.
ARAP just
That's it. But the
but really,
bookkeeping,
I was just gonna say bookkeeping services, right?
yeah,
But
yeah,
and maybe a P&L, but
correct.
it all consolidates up at
Yeah,
the
the
it's really my
controller,
CFO at the
CFO
consolidate
controller can be
exactly.
on the up. Yeah,
So to answer your question is
yeah.
yes, that definitely shared services by far is the first of all, help you save money, right? And
Hmm.
more importantly, you have the expertise and the people you trust at your company level.
Yeah. What synergies are real versus fantasy?
I think the fantasy is that you're gonna get an unbelievable multiple, valuation by doing all this, by doing that. You have to be realistic on what you can do. And again, what I mean by that is if you, buy a company, you have, "Okay, I'm gonna do 1 and 1, equals 4." There has to be realistic in that 3 economies of scale, and what can you really achieve with revenue growth, right?
Hmm.
Because remember, those are the 2 things, the linchpins, right? 3 and 4, right?
Hmm.
So you have to have realistic expectations
Hmm.
on that, right? You can't just say, okay, I'm doing 10 million and then I'm going to do with this company, I'm going to do 25 million next year. Can you? You know what I mean? So you have to have realistic goals, I think. And
Hmm.
when you're planning out,
Yeah,
right?
it's fair, fair.
And also when your economies of scale of the SG&A, okay? If I can I get a 5% savings or a 10% savings,
Hmm.
or maybe I'm unrealistic. I think I can get 20% savings.
Hmm.
You got to be realistic on your goals.
Okay, let's talk about the capital structure. Debt versus equity in high rate environments.
The way that I buy companies, so let me go back to that, right? So my deal structures are pretty simple, right? There's a cash component, right? And that cash component can either come from debt or equity, right? And then usually it's off my balance sheet, right? So, but it could be debt, as well. And then I usually have an earnout component or a note component, depending on earnout or note. And the note would have a clawback because I want to make sure, I have de-risk as much as I can. And my earnout's usually against gross margin versus net. And the reason being is because I need the owner that I'm buying to have the same mindset as me. I do want to grow the EBITDA, but if I had his earnout against the EBITDA, if I want to hire people to expand his business, he's going to say, Alan, I'm not going to bring this. You're putting this as
Correct.
expenses. It's going to hurt
Correct.
my earnout, right? But if I do it against gross margin, it doesn't
You
hurt,
put
right?
it on gross profit, right?
Yes, I do a gross profit, right?
Gross profit.
Versus net.
Yeah, yeah.
Because again, I
You
can
don't put it
throw
on
around.
top line
Yeah,
because it might hurt.
that's
But
correct.
gross
But I
profit,
gross
you're
profit because
okay.
that's
Correct.
if you think about gross profit, that's the actual line that you pay your bills and make your money.
Correct.
That's really the line, right?
Yeah, yeah, yeah.
So I just want to make sure. So we're on the same page on that. But anyways, to go back to my deal structure. So I have a cash component. I usually pay anywhere between 50-60% cash at close. And then the other 50%, as an example, would be an earnout, which is maybe 25%. And then I usually have the owner roll back equity if and whether I give them equity in my public company or if I'm doing a private sale, they keep equity. Then within 3 years, they can buy that equity back, right?
Mm-hmm, mm-hmm,
Or if it's stock, they just keep the stock.
mm-hmm.
But if I buy, and the goal is they have to believe that we can grow their EBITDA line, right? So therefore, that equity that I'm rolling back that equity is a lot more than what it is today. That's why I keep telling everybody after a 3-year period, which your valuation is today is $100. In 3 years, it could be $500,
Correct.
right? So
Yeah.
that's the key. I actually came up with a form that actually shows owners what they will make in 3 years based on a 10% growth, 20% growth,
Mm-hmm.
even on the stock that I give them. It grows to $1, it's $1.50, it's at $2. So I actually have a whole sheet because owners don't know, and it's hard to an owner, anybody really, to say, okay, what's going to happen in 3 years? I don't know,
How long
but
is normal lockup period with those
in a
companies?
public company,
Correct.
anywhere between 6 months to a year.
And it's the same thing to the sponsors as well, right?
Yep.
They changed it.
Yeah.
Before, sponsor could do it from the day one. Now, actually, they're in the same ship.
Yeah. It's saying we do
Yeah.
6 months to a year.
6
Yeah.
months a year.
Yeah.
Okay, yeah, it's fair.
Yeah, no, it is, and
Yeah.
because what you don't wanna do is buy a company, you give him stock, and then he sells it the next day. That's not gonna happen, because then your stock, goes down, right? Yeah. And they all understand it,
Yeah.
because it is, it
Yeah,
is
because I got an offer like I think 2019 or 20. It was a SPAC reverse merger. I refused it because at that time the sponsor could exit, I couldn't.
No, don't do that deal.
Yeah. That's why
That's
I
smart.
didn't. Like I was like,
It's funny,
oh,
I just had that meeting before I met you, we brought that up as well,
yeah.
because, he said, so everybody's on the lockup.
Yeah,
Yeah,
now in
yeah,
lockup
yeah.
I understand. Like if you do a deal and everybody's in lockup, it's fair, right?
Yeah, oh,
Like
no, it's fairness, really,
yeah, it's
and what
fairness
you don't
and the
wanna do is
goals are
buy a co
aligned.
yeah,
Goals are aligned. But
exactly,
if the
exactly.
sponsors can exit right away,
No,
then they will
you
just
you
dump
did the
you.
right deal. If you did that deal, you wouldn't be here talking to me today.
Correct.
You'd be asking me for a job.
My minority pooling versus full acquisition. Which one you would choose?
Well, I told you my best way, it's always full acquisition.
Yeah.
Okay, for me, right? Because I'm a public company,
Yeah,
we're
yeah,
full acquisition.
because
However, they will have. I will never do a minority acquisition.
yeah,
Okay, because I need to be able
correct,
to call
correct.
the shots,
Good
right?
flow, yeah.
Yeah, but as I explained in my deal structure, there is rollback of equity, but not. It's
Mhm,
25, 10%,
mhm.
15%, and it's either public stock or they keep the equity in the company, and then I buy it back. But we're on the majority all the time.
Yeah. When does the fragmented industry deserve a public vehicle?
And anytime.
Anytime.
Okay, you got to be able to show the market that
You
this
should be able
this
to
is a
consult.
growth industry, and investors like fragmentation of industries because you can grow because
But
it's
you
so
should,
fragmented you can
but
buy
you should be
companies.
able to consolidate enough, right? Like at
No,
least few
no
hundred.
question about it. That's why you like fragmented. That's why investors like fragmented industries because you have room to grow. There's
Yeah.
so I'll use my industry, staffing. There's so many staffing companies out there, small, medium, big size, that are not public or not, big enough to, to
Hmm.
call the shots or being a strategic. So there's so many out there
Yeah.
that, that's why there's always inventory, you know what I'm saying, to buy.
Would a SPAC make sense for the platform?
Yes, it could. SPACs are difficult in the sense I looked at SPACs, be honest with you, and depending on the SPAC and depending on the sponsors, depending on what they're looking to do, how much cash is in it. I mean, there's a bunch of things you need to figure that out. I'm not. I don't want to mislead you. I'm not, an investment banking guy. You'll need, definitely need help on that. But just from what I did on SPACs or learned on SPACs, yeah, SPACs can be useful because what's good about it too, you're already public, right? Or the public vehicle, which is usually a NASDAQ or a New York Stock Exchange. You usually have cash in it. So you got to find out about that, and then you got to find out also about the shell or
Correct.
what you're going to do. So there's different mitigating factors. I never did I never did a SPAC personally. I shopped around I definitely talked to SPACs. I don't know. I went more traditional, which is really I merged into a public company or I
Yeah.
merged into a shell. You know what I
Hmm.
mean? And so I did it that way. But SPACs are good. You just gotta make sure your SPACs really SPACs was really good at one point, then was really bad at one
Correct.
point because you said
I
the
think so.
sponsors sell out,
Yeah.
so
Yeah. Yeah.
your
Yeah. Yeah.
SPAC
Yeah. Yeah.
starts at $10 and then it's down to 5 or 2.
Yeah.
You know what I mean? So you got to make sure on all that. And again, I would advise anybody to get a professional like an investment banking to really help you on that.
Yeah. 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 It's
I know
good.
enough to be dangerous, and I don't want to tell you, I mislead you on that. But I know, you know as well as I do. You need to really look at it. So
Okay, let's talk about AI and infrastructure. Does AI increase valuation?
yes.
Yeah.
Yeah, and the reason we talked about a little bit before, AI gives you the chance to be more quicker and better at your job,
Hmm.
right? It gives you the tools to be able to do that, right? And I'm in the staffing industry, so recruiting is big, right? So it gives me a chance to really streamline recruiting, right? And to get the right candidate at a faster clip,
Hmm.
right? And it also looks for my organization, it helps me even on the M&A side to do an analysis of the company I want to buy, right? So where it used to take me whatever. I used to do, when I was CEO, I had to do these analysis to show my board or my M&A committee, this is why I want to buy the company.
Yeah.
Right. And here's what we're going to do and all that. And it used to take me, it's time consuming. I had to do it. Right. I had to really sit down, go through their finance, do the whole thing. Now it's 10 seconds or 20 seconds. It's done for me. As long as I put the right information in, the AI gives me that. So in that regard, yes, it helps me train. I wish I had this back when, but it is what it is. But the answer to your question is yes. AI to me is a tremendous tool. Utilizing right.
Right.
Yeah.
And it does increase the valuation.
No question about it, because you're going to see that. And I'll be honest with you, and I use my industry, but all industries, everybody has AI now. You have to, you know what I mean? Some form of it.
How important is centralized data?
And very important. Okay. Because when I buy a company, I don't want to decentralize the data. I want to centralize the data. I want control of that data.
Correct.
Right. So, and the only way you do that is so remember I told you we do, during the, integration, right? You have in a sense, an economies of scale, so you're creating a centralized database versus decentralized.
Yeah.
Right. And you want the control aspect of it. And by the way, that'll help your valuation down the road as well.
Correct.
Yeah.
Correct. Yeah. We are basically, we use Power BI and to centralize an architecture and everything else. When it comes to the recruiting and HR, like centralized HR and Holdco, you can actually, we push the culture of the person is leaving or for some reason the manager wants to hire unless for some wrongdoing, we can always not recycle. I cannot use the word of recycle. We can move the person within the ecosystem elsewhere, or if the candidate doesn't fit in one, we can either put it on virtual bench or we can actually
That's exactly
utilize
right. It gives you more options.
More options.
None of that too, but as an owner or as a CEO, you want to control as much as you can.
Correct.
And a centralized database, centralized accounting.
Same thing.
Anything that you can centralize only helps. I centralize my marketing.
Correct.
Right.
Correct.
Because again, I want to make sure everybody's doing it our way per se. Even though they do have latitude in the subs.
Correct.
But you still want to have control of your information. What it really comes down to.
And then you can reutilize the same data for many different purposes.
Because it's centralized.
It's
exactly
centralized.
Right. No, you're 100% right.
Yeah.
You're doing it right.
Yeah. Would you pay more for companies plugged into the shared infrastructure?
Plugged into my shared infrastructure?
Probably if you would take them all together, right?
Yeah. Oh, yeah. I would definitely.
If you would own the shared,
no question about it.
It is a platform, basically, right?
Yeah, exactly. If you brought in small companies together and somebody puts it all together, which you have a shared platform, without a doubt, to me, it's a platform.
That's why. Then we are doing correct stuff.
Exactly. That's right. Yeah.
Looks like we are doing the right thing now.
Yeah.
Okay, it's about the cohort-based virtual merger platform, right? So if someone build a cohort-based virtual merger platform, where would it break?
It depends on the mitigating factors, right? So you got to look at the different. It could break. I mean, anything, can happen to anything, right? But for the most part, if it's done right and you're watching it and you're on top of what, the virtual part of it, to make sure that make sure that everything is correct in what you're looking to get, then you should be fine. What I'm basically saying is you have to oversee it. You have to oversight it, right? There has to be complete oversight and oversee in that. Otherwise, it can. So, 'cause again, everything we're talking about right now on the technology side is sort of new. You know what I'm saying? In a sense, right?
Yeah.
And so you need somebody to stay on top of it. You know what I mean? So
what kind of governance would you require?
Well, first of all, depending on the size, right? If it's on the accounting is the biggest part, right? You got to make sure that their security is big, right? And that you have certain things in place, so you can mitigate fraud. So there's governance like that. As a public company, you're governed. You have to have rules of governance in order to be public to show the people anyway. So that's easy because it's very transparent. What your governance is. But and I sort of use that as even on the private sector, right?
Correct.
So you have governance that's why you audit in essence, because that is the purpose of an audit is governance, right?
Yeah.
So that's a governance then. But you also have to make sure that whoever signs the checks, I mean, there's different ways to make sure that there's no fraud, that nothing can happen, make sure there's no oversight. And I think that's the key is oversight. Make sure you have correct oversight to all the things that you're doing, whether it's putting something in your database, and because what you don't want to do is to have your database stolen.
Yeah.
Right. So how do you not do that? Right.
Correct.
So, and that's why I keep going back to that centralized database. It's hard to do that at one point. And I know myself, when I was running companies, I would say, okay, well, this person can only see this database. You know what I mean? Not the whole company,
Hmm.
just their company's database. Unless they're doing other work, then I can open it up to this particular company. So you have governance that way because all governance really is you're trying to make sure that you're lawful, and you're morally and ethically correct.
Hmm.
That's what it really comes down to, right? And to make sure there's no fraud. I mean, those are the legal stuff is easy, but
Yeah.
even on the moral stuff, you want to make sure the ethics stuff that you're running your business correctly,
Hmm.
and that is really what governance really is.
Yeah. And when you put those mergers together, you're putting international, right? Like not just US.
Correct.
So that they can be
Yeah.
actually anywhere.
Yeah.
If there is a platform like for the virtual merger and cohort, and would you participate and under what structure?
That's a good question. I don't know enough about it I don't want to give you a wrong answer because I don't know enough about it to give you
Yeah.
that answer. But again, I go by the same principles I've always looked at.
Hmm.
I would participate in anything if if the money structure is correct, the financial structure is
Hmm.
correct. I'm making money. I can grow the company. So those, there's certain tenets that I look at, no different than anybody, So, but I don't know enough about it to give you an
Yeah.
answer on that. But I do know the way I buy companies and the way I participate.
Good. Okay. What kills 80% of the acquisitions?
Untruthfulness, when I do due diligence and I see that, it's $100 and they told me it's $200, so that kills it pretty quickly. So the financial and also honesty, that's a big thing for me. And also I just want to make sure there's a cultural fit in essence. So when I do due diligence, I look at cultural, operational, and financial. Any of those things can be a red flag. And once I see a red flag, I don't need it. There's
Hmm.
too many. Remember, I said we're fragmented industry,
Yeah.
so I'll just go on to another company. I don't need a headache. You know what I
Yeah.
mean? So I try to avoid that as well. But that's 80% would be financial, operational, or culture fit.
Got it. What kind of advice you would give someone building a consolidation platform?
The first thing I would do is to make sure you have the right industry,
Hmm.
right? That can actually thrive, right?
Yeah.
That's the key, right? Make sure you can make money at what you're going to
Yeah.
do,
Yeah.
right? And then,
Make sure it's growing, right? Like
yeah, make sure there's a growth industry,
growth
right? You don't
industry.
want to,
Correct.
do
Yeah.
that. Second thing is to decide how you want to do it. I've always been a favor, as I told you earlier, of a platform company, and then bring in smaller companies underneath it. So if that's this is the way I would do it. But if I would find a nice platform company who's already got some systems already intact that you can help make it better, and then bring in these smaller companies under that. So the platform company to me is key
Yeah.
because after that you can find these other companies.
Got it. What do you think? What does the next decade for consolidation looks like?
Again, depending on the industry, I think very strong.
Yeah.
I'll tell you what's happening it doesn't matter the era. We're in the era today. People or companies don't know what the future is. So it's much better to be part of a bigger company than a smaller company, right?
Yeah.
Because the bigger companies have a better chance to survive
Yeah.
than a smaller company. So, so the answer to your question is, I think I mean, I'm in LA right now, right? The home of, Paramount wants to buy, Warner Brothers and Netflix. I mean, those are two behemoth companies, all of them, right? And just think about us smaller guys, right?
Yeah.
And I'd rather be part of a bigger company than a smaller company. I think I have a better chance for survival when I'm with a bigger company. You're de-risking a
Yeah.
smaller company de-risk themselves.
Correct.
So to answer your question, I think the decade's going to even see more. We're
Yeah.
seeing more of that now.
Yeah,
I mean,
yeah.
I think there's more. I can't back it up because I don't have it in front of me. But I think there's more things going on right now with
Yeah.
consolidation than ever before, right?
Yeah, yeah, yeah.
So, and I think it's because of that. You want to owners want to de-risk because they're so like in today. Here we are in February of 2026. There's uncertainty
Correct,
in the
correct.
marketplace, right? So how do you stop that uncertainty? Well, if I go to a bigger company, I'm taking some chips off the table,
Yeah.
right? And on top of that, I'm part of a bigger company, which has a better chance for survival.
Right. If you really look at put it in the analogy of the country, like it's better to be under big country like United States
By
or like
far, yeah,
European
that's
Union
exactly
than
that.
be like a small country like
That's
you have no access to resources.
that's exactly. You're absolutely correct. That's actually a better analogy than what I had. But you're right. I'm going to use that. No, but you're right. No, that is the concept, though. You're absolutely
Correct,
right. So if
correct.
you ask me in the next decade, I think it's going to be the same.
Yeah,
I mean, if I'm a small guy,
right.
it's funny. I'm doing this roll-up strategy now up in I told you this company in Canada, and these small companies I talk to, and they said, yeah. I mean, what are they gonna do?
Yeah,
You know what I mean? I mean, where are you gonna go?
correct.
Where are you gonna grow to? You know what I
Yeah.
mean? And their aspirations if you're a small company is to sell to a bigger company. I mean, who are you gonna
Correct.
sell to? You know what I mean?
You're not living it to your next generation, right?
Yeah.
Your kids don't want to do that, what you do
No, the
anyway.
kids, yeah, yeah, yeah. I have 2 kids that are not in my field. But interesting enough, though, but you're absolutely right. I mean, who do you sell to? Do you sell, or maybe your employees buy you, but that's,
Yeah.
and they don't have
So I
the
think,
capital to do
yeah,
that. And,
yeah.
and
ESOP,
you
you
take
can
a
do it, but
note
it's not
back.
good.
They're
No,
not going to do
no.
it. You know what I mean? So,
No, no,
no,
no. It's
no.
like when the people build the personal brands, that's the only exit you have, like Tony Robinson.
Yeah.
He had to sell it to employees.
Yeah. Yeah.
Yeah.
Yeah.
But
Or you give it to your kid,
do you
right?
give it to
Yeah.
your kid?
Kids.
Right,
Yeah. Yeah.
right.
Yeah.
Yeah. It's not scalable, but it's the best way, I think, to strategic buyer like a public company. It's the
Yeah.
best way.
Well, again, the way that I'm buying the companies, again, I keep their DNA, right? I keep their brand. I
Correct.
keep the way they're doing business.
Correct.
So
Correct.
company, because I agree, when a person or an owner builds their company, they're proud of their brand. They're proud of what they built.
Yeah.
Well, I don't want to take that away. I want to keep their name, because again, how am I going to compete with the big boys, right?
Right.
I can't. I don't have their balance sheets. I don't have their money, but we're a network of boutiques,
Correct.
right? And that's the way
Yeah.
that I position ourselves.
Yeah. Alan, thanks for the conversation. Today, we talked about what really drives the value in M&A, the structure, integration, scale, and preparation. The key takeaway is simple. Successful exits aren't the luck, they are engineered. If you are a founder thinking about growth through acquisition or preparing for exit, start building intentionally now. Thank you for listening, Founder to Founder podcast. See you on the next episode.